of Economic Research at UBS. Aaron, as always, thank you so much for joining us. What exactly are you expecting in Jackson Hole?
It's, as you said, I think it's a bit too early for advance warning on the taper. So the minutes, I think, made that clear from the last FOMC meeting. So what we think he's going to talk about, and it'd be helpful if they released the agenda a bit earlier, because obviously we don't know yet. So,
it would.
But so what we think he's going to talk about is the separation between the taper decision, the balance sheet, and rate lift off. And obviously, the whole strategy to make this tantrum-less is basically to talk about it until you're blue in the face, make it very clear that once you start tapering, it doesn't immediately lead to rate hikes. And so that's a theme that's been present in the last couple of FOMC meetings, and various participants have been talking about it, and so we think he'll expand on that. So it'll be an opportunity to talk about where the economy is exactly in terms of the material progress, talk about inflation, talk about the labor market, but stay away from the advance warning signal, which we think probably comes in September.
Aaron, where do you see inflation? So when you look at what exactly is priced in terms of economic prospects and the kind of inflation that you're expecting in the next 6 months, what should we be watching out for?
Yeah, so we think we're now at the peak, and we're in the transitory camp. So we think core PCE is going to come crashing down by the time you get to the end of next year. We're actually at about 1.5, 1.6 on core PCE, so we're way below the Fed forecast, and that's partly because we're a bit above the Fed for this year. So, and we think, there's a little bit for everyone in the last inflation print. So I think the factors that we're pushing up very strongly, like used cars, are clearly now coming down, and we think those prices are going negative the next couple of months. So by the time you get to the end of the year, we think we're going to be running, monthly prints of about 10 basis points. So way below where we've come from, but we're not quite there yet. So I think in the last print, we're still annualizing at 4%. Even though it was half of the pace of the previous 3 months. So I think we're sort of in this, still in sort of the phase where both sides can argue it either way. Now, we think there's sort of enough evidence that inflation really starts to moderate from here, but you don't really start to see that until probably after they have to give the advance warning signal. So I think that advance warning signal on the taper that we think comes September is largely dependent at this stage on getting another sort of close to 1 million payroll print next week. Then they give the advance warning, and then you wait until you get to probably November to sort of give the sort of firm signal on, okay, we're ready to pull the trigger here.
Aaron, I don't know how much the market or actually how much economists are actually looking at who would come, instead of Jay Powell. So we understand that Janet Yellen has also given her blessing to people, in her circle that Jay Powell should stay on. We're expecting President Biden to make a decision on that in September, but he's seen as possibly one of the most dovish central bankers that the Fed has had for quite some time. If he doesn't stay on, what happens?
So I think the alternatives that haven't mentioned, people like Lil Brainard, I don't think would be materially more hawkish. So I really, in terms of the sort of the cohort of people you could choose an alternative candidate from, I think they're all going to be very similar. And I think that's partly because Yellen is a Treasury Secretary, and partly this is a continuance of her policy. And so I think the people who are involved in making these decisions are all quite like-minded, and I think they're quite happy with the Fed policy. So I'd be very surprised if we get a candidate that would be a significant deviation from Powell. But you've seen the same stories as me, which is that actually his chances of staying on are pretty decent. So we'll see.
Aaron, are we importing inflation from China at all, or given the regulation that we've seen in China, is that a thing of the past?
So commodity prices are obviously a big feature of this year's inflation pressure. Now, a large part of that's oil, and that's really not China in my mind. So, where China pushes up commodity prices is in metals, and there we're now clearly seeing sort of the pressure come off. We're seeing a rotation in Chinese growth away from infrastructure investment. The last data print was annualizing at minus 10%. So as we go from sort of public stimulus focused on infrastructure and property market to more consumption-led growth in China, you get less commodity intensity in import demand, and so that takes a little bit of pressure off commodity prices, and all that helps on a headline. But so that matters, but it doesn't really matter that much to the central banks, because I think these commodity price pressures are always very well understood. And so I just don't think that's where the uncertainty is right now. So I think China, having this weak data set that we saw last month, that matters just because Chinese growth matters to the rest of the world, and it matters to EM, and it matters to aggregate momentum. But in terms of the inflation dynamics, it's really much more about, I think, the opening up dynamics and the supply bottlenecks. And there, it's really not so much China, I think, that is sort of causing those bottlenecks. So I think that's where the real uncertainty is. How long do those chip shortages and container shortages last? And that's, I think, what the central banks are focused on.
All right, Aaron, thanks so much. Aaron Kaplan, the Global Head of Economic Research at UBS.